So very good afternoon to everyone, and the topic which I have for the presentation today is a very interesting one, tax planning. So before I start with the same, I would like to put a small disclaimer that because it's quite a sensitive topic, so that examples which I would be taking, please take it in the right spirit, and these are all my personal thoughts. So if we talk about tax planning, the first and the foremost question which comes in the mind of everyone still till date, that is planning legitimate? Can I plan my own taxes as an individual, as a corporate, as an HUF, as a firm, or whenever I am planning something, it has something grey which might be tomorrow looked with a lens. So we are trying to today in the next 20-25 minutes try to see that how legitimate the planning can be, and when it is turning grey, what happens. So first of all, let us try to understand what is meant by tax planning and why it is so important. And if we try to define tax planning, I tried to search everywhere, but I could not arrive at a definition of what constitutes tax planning. So basis my limited understanding, what I have tried to do is I have used, I think this slightly looks juggled. Okay, anyways. So what I have tried to do is I have tried to put some words and phrases to it to define what tax planning basically means. So tax planning, first of all, is a legitimate process. Let us accept it. There is nothing illegal in tax planning. It's absolutely legal. It's a means of reducing or minimizing the tax incidence or tax liability by availing the benefits, exemptions, allowance, deductions, etc., which are all available under the law. So it's quite important that the four corners of law are being duly respected when we do some kind of tax planning. So I would take some practical examples. I as an individual. So when I as an individual do a tax planning, when I take a deduction under section 80C, 80D, these are all legitimate means. The law itself has allowed us. So there is nothing called hanky-panky in a tax planning kind of scenario. When I talk as a corporate, if I am setting up a manufacturing unit and if I am availing the benefit of a lower tax rate, it's absolutely fine. The intent of the law was to give you the benefit. So what's important is the intent. What was the intent of the law? Similarly, if we take some other examples, people do a lot of planning when it comes to mergers and acquisitions. So till the time they are in the four corners of the law and the letter of the law and the spirit of the law are marrying to each other and you are duly adhering by the same, tax planning is absolutely legitimate. So why tax planning is very important? So when we talk about corporates, what is the objective of running a corporate? Objective of running a business per se. The end objective is to maximize the shareholders' wealth or the owner's wealth. Let us accept it. I'm not talking about an organization which is not for profit, but otherwise an organization out there has to make profit to survive. And if you run through the P&L account, one of the heaviest expenditures in any P&L account is the tax cost. Now that might be a direct tax cost, which you might be saying it's below the line, or indirect tax cost, which might be above the line. But tax is definitely one of the heaviest expenses. So if you are able to rationalize your taxes through effective planning, what you are trying to do at the end of the day, you are trying to maximize your PAT, which eventually means you are trying to maximize the shareholders' wealth or the owner's wealth. Second, very importantly, the cash flow, which is the bloodline for any of the businesses, is heavily impacted the way you plan your taxes. So I would take an example. Generally, we talk about tax planning as while we are preparing the positions for the purpose of a return. But I would take one step ahead. How tax planning also impacts cash flow situation. Often what happens is that a tax demand is raised on us. One of the natural instincts is that we are not going to pay the demand and preserve the cash. This all of us do. Most of the times what we do is we take stay orders and we sort of try to conserve the cash. But at the same time, there are still many organizations which are in fact quite cash rich, and they need to take a call that whether payment of tax today is more efficient or payment of tax tomorrow is more efficient, depending upon how strong my position is. Because if you're not even paying taxes, you always have the risk of that interest meter running. So if you're a company which already having a lot of cash reserves sitting out there and you are only invested, for example, in only FDs, think about it, that whether I should pay the taxes. Some of the other examples is, for example, we do lot of tax planning when we do our capital structuring. Debt versus equity, a typical example. Debt carries an interest cost which is tax deductible. Equity carries a dividend cost which is not tax deductible. So there is lot of planning which one can do at that front also. Investment decisions. Typically, as we go forward, the concept of SEZs and STPIs is vanishing, right? But if you look on the indirect tax side, there are still lot of locational tax incentives which are available. So eventually, it helps to boil down on what is your total tax cost with all inclusive direct and indirect taxes. So you can plan a lot over there. One of the major things is competitive advantage. So what happens is that, let us assume I am manufacturing a product and I am doing a classification under a particular HSN code. Now, as per my classification, that HSN code is attracting an 18% GST. Whereas someone in the market is selling a very, very similar product, even if not identical, and the position which he is taking, GST is 12%. Do you think you would be able to survive in the market? It's going to be very difficult. Of course, I am not saying that you have to take unnecessary risk, but you have to understand and plan your taxes accordingly. That is the other HSN code which is being taken. Is this something which I can also contemplate? Because otherwise I'm losing out on a competitive advantage. Last but not the least, this is very important for the purpose of your overall tax risk management and eventually managing your litigation costs. The quantum of litigation in India is enormous. There are no two ways about it. And the moment you realize the fact that whether you have to spend and invest in the beginning while you're planning and taking up positions, vis-a-vis post facto rather fighting it out. Do a comparative analysis, and trust me, you would find that it's always better to invest in the planning part of it rather than the litigation part of it. So as I had started the discussion, I said that tax planning is legitimate. Yes, we have the right to do it. It's as simple as that. But then typically what happens is that tax planning often gets confused with terms like tax avoidance and tax evasion. So again, these terms are not defined in any of the acts, and whatever I am sharing is based on my own understanding of the usage of the terms. I'm so sorry that it looks juggled up. So tax avoidance. So tax avoidance, first of all, if you would try to Google and you would try to find out that first of all whether tax avoidance is legal or illegal, you would find a very, very thin line between the two, between the legality and illegality. And there can be mixed opinions on the same. However, this is my personal opinion that tax avoidance as such is availing a legally available benefit. So there is nothing which is illegitimate about it. The problem is that when you are doing a tax avoidance, you are trying to exploit a loophole in the tax law. And what I mean by exploiting a loophole? Exploiting a loophole generally occurs in situations where the letter of the law is being duly followed by you, but the intent of the law is being violated. So the intent with which the law had been implemented, you are trying to sort of find a shortcut or a via route to that. Just to take an example, because this is something which has been a lot of public domain, the Vodafone incident of the indirect transfers. So yes, there was some aggressive tax planning which got a color of tax avoidance, and you all know what the fate was. But now, when the law has been amended, when the dust has been settled, if someone still tries to create such structures, now it would not be tax avoidance. It would be now tax evasion. So tax evasion is something which is not legitimate. You are trying to create a tax advantage by concealment of facts, suppression of the same, misrepresentation, tampering with the evidence, and these things are something which directly lead to criminal liability. So it's a very, very thin rope to walk on, but what is most important while you decide that you land on the right side of the law, try to understand what was the intent of the law while it was being implemented. The intent of the law often is very clear from the memorandum while the law is being implemented, the discussions which had happened at that point of time, because if you do not respect the intent of the law, you are more likely than not going to land on the side of being categorized as tax evasion. So I would move on to the next slide. See, the government also knows that many people try to land in a scenario which is strictly not tax evasion, which is not tax planning, but a tax avoidance kind of. So what does the government do to curb that? So typically in any law, there are two kinds of provisions which the government comes up in any countries. One are the general anti-avoidance rules, which are very, very wide in scope and which almost override any other provision in the act. As we have in India also, few years back, GAR which was implemented. But then at the same time, for handling situations which are very, very specific in nature, there are certain specific anti-avoidance rules also. I would take a couple of examples. So for example, under section 40A3, when the law itself understands the fact that lot of payments being made in cash are often used as a means to avoid the tax. So the government makes a law that any cash payment you are making above 10,000 rupees in cash is not going to be allowed as a deduction. So this is a very specific anti-avoidance provision. Similarly, while you are dealing with related parties, making payment to related parties, there is often a color of the payments being either overpriced or underpriced. So again, those payments have to be at the arm's length. Now this may be governed by provision 40A2 or eventually transfer pricing or something like a deemed transfer pricing under section 92B2. So these are very, very specific incident based measures to ensure that people do not invest their time, energy and resources in tax avoidance. So what now I am going to do is that I am going to take you through some incidents or some examples of international tax planning. And if we talk about international tax planning, most of the time what happens is that the people who are working in the MNCs do spend a lot of time in designing the structures, and we will take few examples in relation to the same. So one of the common tax planning strategies is to decide the holding company location. And this becomes very important from two fronts. One is from the front of when the holding company is investing, it would get a return in the form of dividend. So often it is tried or attempted that the parent company jurisdiction is one which has lower tax rates, so that the dividend income is either exempt or it's as such taxable at a very low rate. So all this of course is being subject to two things. One, do you have a commercial substance in that holding company? And secondly, as we are graduating to the BEPS world, are you duly able to establish that this all is not relating to base erosion. So that is one. IP owner again, the IP owner who gets the royalty. It's very important that where do you situate the IP owner. Also, what happens is that there is a wide network of tax treaties which get used in deciding that how to minimize the minimize the withholding taxes. Transfer pricing arrangements. So often while we plan for transfer pricing arrangements, these days APAs are very popular. That you get the things right on day one, being transparent. Also, it's important that there are rules, safe harbor rules and thin capitalization rules, which you can look into, and mutual agreement procedures. So these are some of the ways you can plan your taxes while you are doing cross-border transactions. So now I will move on to my last slide. What are the pillars of tax planning as such? So the sessions which we were having just before this, there was a statement that was made that now tax has reached to the boardroom discussions. And that is so true. Because the tax has reached to the boardroom discussions because owing to two facts. One, owing to the fact that the compliances have risen significantly in recent past. Especially after introduction of GST and with TDS being tinkered every now and then, the compliances have just shot up the roof. So one is the reason, but the second is the reason what I personally feel is when you do tax planning, how aggressive or conservative you are. Because it is very sure that an over-aggressive tax planning would always lead you to an over-aggressive audits and a boardroom discussion which would be definitely required. So having said that, the pillars of tax planning, if we say, so there are 4 pillars of tax planning. Number 1, compliance, documentation, technology supporting the same, and last but not the least, substance over form. So in case you are able to do your compliances right on day 1, and you have a real-time contemporaneous documentations supporting that, which coupled with technology to take care of the above 2, and finally, if you keep the key principle in mind whenever you're planning taxes, that do not always go by the legal form, test the substance. Is this transaction which is going to be a transaction done by a person with rational commercial understanding? What is the commercial rationale behind the same? The most important. So these are some of the key takeaways from my side, that whenever you plan your taxes, please keep in mind that even if, for example, I am trying to create a unit in an area where there are going to be a lot of compliances involved, make sure that you're duly factoring in these things. Thank you so much. That's it from my side.